Global financial markets are entering a phase of recalibration. After several quarters of optimism driven by expectations of rapid monetary easing, investors are beginning to adjust to a more restrained reality. The assumption that central banks would quickly pivot toward aggressive rate cuts is being replaced with a slower, more conditional outlook. Recent macroeconomic data reflects this shift. Labor markets remain resilient, consumer spending has not collapsed, and inflation, while moderating, has not declined fast enough to justify an immediate policy reversal. This creates a complex environment. Economic activity is not weak enough to force emergency stimulus, yet not strong enough to generate broad-based acceleration. In such conditions, policymakers prefer patience. As expectations adjust, capital flows begin to change. Investors are gradually trimming exposure to high-valuation growth stocks, particularly those priced on long-term projections rather than near-term earnings. Companies that previously benefited from aggressive future revenue assumptions are now being evaluated on cash flow stability and margin sustainability. Bond markets reflect the same uncertainty. Yields fluctuate within a relatively narrow range, signaling that investors are divided on the trajectory of future interest rates. Volatility in fixed income remains elevated compared to historical norms, suggesting that conviction is still fragile. A noticeable sector rotation is underway. Defensive industries such as utilities, consumer staples, and parts of healthcare are attracting incremental capital. This pattern typically emerges when investors prioritize stability over rapid expansion. It does not necessarily imply an imminent recession, but it does indicate a preference for lower earnings variability. Currency markets are also responding. The US dollar has strengthened modestly, reflecting global caution and relative economic resilience. A firmer dollar places pressure on emerging markets in commodity-linked economies, tightening global financial conditions indirectly. At the same time, commodities show mixed signals. Energy prices remain sensitive to geopolitical developments and supply constraints, while precious metals are gradually regaining momentum as hedges against uncertainty. Gold, in particular, tends to benefit when real yields stabilize or decline. Equity indices present a fragmented picture. Some sectors continue to report stable earnings, but forward guidance has become increasingly important. Investors are focusing less on past performance and more on management commentary regarding demand trends, input costs, and capital expenditure plans. Markets are rewarding transparency and punishing ambiguity. Liquidity conditions also deserve attention. In certain segments, trading volumes have moderated, making price reactions more pronounced when unexpected data is released. When positioning becomes crowded, even neutral information can trigger sharp short-term moves. What stands out most in the current environment is not fear, but adjustment. Markets are transitioning from a narrative-driven rally to a fundamentals-driven evaluation. Valuations are being tested against realistic growth assumptions. The premium once assigned to distant earnings potential is being reconsidered in favor of measurable profitability. In the short term, this dynamic supports continued volatility. In the medium term, it may contribute to a healthier market structure. Corrections under these circumstances function as rebalancing mechanisms rather than systemic breakdowns. The broader takeaway is that financial markets are not collapsing, they are repricing. Investors are adapting to a world where monetary policy remains cautious, growth is moderate, and earnings quality matters more than expansion speed. In this phase, discipline, balance sheet strength, and capital efficiency become decisive factors. Periods like this often feel uncertain, but they are also the foundation of the next cycle. The distinction lies in understanding whether movements are driven by structural change or temporary sentiment shifts. Those who can identify that difference tend to navigate volatility with greater precision.